Hi everyone, welcome back to a IFRS 16 video on sale and leaseback transactions. Now, sale and leaseback is, I think, potentially a topic that not really a lot of people like. So I personally think I quite enjoy it. So we're going to do a quick video of how to account for sale and leaseback transactions in accordance with IFRS 16. Now, essentially, the difference isn't that major, but in terms of, before we get into the main bits of the accounting treatment, I thought it would be good to just debrief what exactly a lease is. So in accordance with IFRS 16, a lease is the right to control the use of an identified asset for a period of time in exchange for consideration arising from a contract. Now, essentially what that means is you've got a lessee and a lessor, and those are two different parties, and the lessor is the person that would be leasing out the asset to a lessee. Now, essentially, a lessee would then obtain a right to use that asset. For example, a machine in production, they would be able to use that asset, and then that would be for in return of consideration. So at the commencement date, a lessee needs to recognise a right of use asset as an asset. So that basically says that they've got they're entitled to the use of the machine or the plant or the equipment. And then they also need to record a lease liability, which takes into account the present value of the future lease payments. Now, if you're not quite familiar with that term, we're probably not going to go and cover that today. But essentially, it's the discounted future value of what would need to be paid for the lease, taking into account the interest rate that is implicit in the lease as such. So on initial measurement, that's what you need to recognise. You need to recognise a right of use asset and a lease liability. Now, that happens at the start of the lease term. So you agree with somebody, and that is when it happens. In terms of the subsequent measurement, you need to record a depreciation charge on the right of use asset, as you normally would with any other asset. So let's say you entered into a agreement with a lessor or another party for the right to use a machine in your trade, and let's say the term of the lease was 5 years, but the useful life of the machine was actually 8 years. Now, there's a requirement in IFRS 16 that states that you need to depreciate that machine, for example, over the shorter of the term or the useful life. Now, in that case, you need to recognise a depreciation charge for the shorter of the lease term or the useful life. And you also need to recognise finance costs. Now, normally the interest rate implicit in the lease, that should be given to you, for example, in any sort of accounting exam. For example, the ACA, Financial Accounting and Reporting, the AAT as well. The interest rate implicit in the lease is stated. So briefly, that is what a lease is. If we move on, sale and leaseback, it literally means that sale and lease back. So it involves the sale of an asset and the subsequent leasing back of the same asset. So we'll ignore the second bullet point, but if you imagine, for example, you have a company that wants to, or that owns a machine, they still need to use the machine, but they need cash, for example. An option is for them to sell it to a second company, so a totally different company. They can sell the machine, and in return they would get cash. But then the machine that they originally owned would be leased back to them And so in essence, you've got a transfer of an asset that you owned, you dispose of it, and then you subsequently lease it back, and you treat it as a lease transaction. So and we need to be careful here in terms of the consideration. So we need to make sure that the transaction constitutes a sale in accordance with revenue from contracts with customers, which is IFRS 15. In terms of the actual accounting treatment, there's a clear 5-step process which I think would help. And if you memorize this, you're pretty much good to go with sale and leaseback transactions. What you need to do is you record firstly the sale proceeds, and by the way, we will do an example afterwards, because I think that just looking at bullet points on the screen would be quite difficult to take in the information. But in terms of the accounting treatment, the first thing that needs to happen is you need to record the sale proceeds. Now, normally that's quite easy to do. You get an invoice, for example. You're invoiced for on the sale. You send out a sales invoice, and you can, obviously that's the agreed proceeds. So you record that in your ledger. You then need to derecognize the asset at its carrying amount. Now, normally, hopefully you have a record of the costs that you brought the asset for. Might be some sort of historical purchase invoice. And then you need to deduct your accumulated depreciation to date in line with the entity's depreciation policy. And a lease liability then, step 3, needs to be recognised based on the present value of the future lease payments. And then a right of use asset needs to be recognised, which is based on this specific formula. So the formula is your carrying amount of the asset disposed. Now, this carrying amount of the asset that's disposed, that is literally the asset that we do recognised here. So essentially you can think of this as step number 2. And to be honest, the numbers that we're using in this formula are already known to us. We just need to know how to actually plug them into the right places. Your lease liability is step 3. Your lease liability that's based on the present value of the future lease payments. And the fair value of the asset, hopefully you've sold you should dispose the asset at a price that reflects the current market rate. So the fair value of the asset would be the proceeds that you recorded on the transaction. Of course, if you had an impairment, for example, whereby your carrying amount was higher than the recoverable amount, of course you disregard value in use. Because you're not planning on using the asset in your trade, so you would take into account your fair values. So it would need to be recorded at fair value of the asset disposed, and you need to recognise an impairment loss as well, for example, in accordance with IAS 36, but that's a point for another time. And then you recognise the gain on disposal. Now, that can, if you're looking at journal entries, for example, which we will do in the next question, that's you'll see how we can get to this figure. So we've got a example scenario here, and we're using BMW. I'm pretty sure we all know what BMW is and what they do. Automobiles, manufacturing, financial services as well. For example, if you decide to purchase a car on finance, they also deal with the finance aspect of the financing. So BMW sold an asset with a carrying amount at the 31st of December 2021 of £7 million and entered into a sale and leaseback arrangement on the 1st of January 20X1. So the sale proceeds were at fair value of 10 million. The remaining useful life of the asset was 4 years. Now, we're not told the term of the... No, we are. So, yes, the remaining useful life of the asset was 4 years. The lease provided for 5 annual rentals of 500,000 payable in arrears. So actually, the useful life of the asset is shorter than, if you remember the point that we talked about earlier, is shorter than the term. So the 5 annual rentals, that would be 5 years, obviously, 5 times the annual rentals. And that's payable in arrears, so at the end of the year on 31st of December each year. And we have a interest rate implicit in the lease of 5%, and the present value of future lease payments was 8.5 million. And we are asked to calculate the journal entries at the date of disposal and calculate the amount to be recognised in the profit and loss in the year to 31st of December 2021 and the statement of financial position as at that date. Now, in terms of what we need to do, so we need to record the proceeds on the sale of the asset, so that's 10 million, and we are given that in the question. We need to de-recognise the asset, so this 7 million is your carrying amount of the asset that we had in the previous question. The lease liability is your present value of the future lease payments, and you simply just slot this in. And then you need to recognise the right of use asset based on the arrangement. So now you are entitled to use that asset, for example. So that would be the 7 million carrying amount that was disposed in step 2, as we talked about, times your 8.5 million lease liability. So that is your present value of the future lease payments over the 10 million, which is your sale proceeds. Now, in terms of recognising a gain on disposal, that's a bit more tricky. You can, of course, do it mathematically and subtract your debits and your credits without adding it into a journal T account, let's say, or simply a journal entry. But in terms of the journal that needs to be recognised, what you need to do is you debit your bank, obviously, because you've received this cash because you sold of the asset for 10 million. You need to remove the asset, which is valued in your books at 7 million. So you remove the asset by crediting your property, plant and equipment account in the statement of financial position. You recognise and this is on initial measurement, remember, at the year end, you would need to recognise, as we talked about on the second slide, you would need to recognise second or third slide, you need to recognise a finance cost, and you need to depreciate your right of use asset based on the useful life of the arrangement. And in terms of the right of use asset, what you would need to do is, so this result is the output of this calculation. So your right of use asset is your 5.95 million, and what that basically says is if you divide the what you basically can do is if you divide the 8.5 million over the 100, well, that will give to you the bit of the asset that essentially you've kept. And in terms of the gain on loss and disposal, well, that's just your balancing figure, which in this case is a gain. So that would be recorded as a profit in your statement of profit or loss. Now, I hope this video helped. In terms of if you have any questions on sale and leaseback transactions, feel free to post them in the comments. It is very methodical, and in terms of how to get your head around this, it's literally just practice, reading, question practice, potentially, and then just writing out from memory, and then looking at a solution, for example. But it's literally just practice. But I hope this helped, and I hope that this is able to assist many of you.